Most retirees ask, do I have enough? But the smart ones ask, how do I keep what I already have without raising any red flags with the IRS? Today, I'm revealing the one move that sounds counterintuitive, but only because the financial media has been lying to you for years. And the simple process that tells you exactly which account to pull from each year to pay less tax. Miss this in your 60s, and you can't undo it in your 70s. Hi folks, thanks for joining me today. I'm Ron Bristol with Advanced Wealth Advice with another personal finance hot take. Today's take is how to create a tax-efficient retirement plan. David had enough money, but how he was taking that money from his portfolio gave the IRS a claim on his income. We changed his withdrawal order and used a simple tax bracket ceiling. Same lifestyle, same income, less tax. He called it a raise for doing nothing new. You're about to get that same blueprint too. For people with a portfolio over $500,000, retirement income isn't just about investments. It's about sequence and source. Which account, which year, which order. Most people wing it. Good stewards plan it. That's the difference between you getting irritated about how much tax you pay and knowing how little the IRS is getting from you. If you want to be a good steward of your portfolio, but don't know where to start, schedule a call with us using the link in the description of this video. Let's start by how we map your money. 3 buckets, 1 vision. The first bucket is your taxable assets. Brokerage accounts, interest, dividends, realized gains. The thing you may not realize is that you have 3 different tax rates from income in this bucket. Your original investment or cost basis is tax-free. That's right, 0% tax on this money. Most dividends and long-term gains in this bucket are taxed at 0, 15, or even 20%, depending on your total income. And the last rate then is interest and short-term gains that are taxed, anywhere between 10 and 35% in this bucket. So being smart about the type of income you earn in this bucket is a great way to control your overall tax rate. The second bucket is the tax deferred. For most people, this is your traditional IRA and 401k. Every dollar in this bucket is taxed as ordinary income, which is usually the highest tax rate on your return. But that doesn't apply until you take the money out. That is why it's tax deferred. Now, the third bucket is your secret weapon against the IRS. It's the tax-free bucket, Roth IRAs and 401ks. The money you put into this bucket has already been taxed. But what makes it so powerful is that every dollar of growth in this bucket is tax-free. That growth is truly tax-free income. The IRS never takes a piece of it. So you won't pay any tax when you take that money out of this bucket. My first question to you is this. Do you know how much you have in each bucket? It's okay if you don't. Most people don't either. But if you would like to know, schedule a free consultation and we'll help you figure it out. At a minimum, you'll feel better knowing where you stand. Lisa defaulted to just taking income from her traditional IRA, the most expensive tax bucket. Every dollar spiked her taxable income and made her Medicare premiums go up. So we flipped the scripts. We started by harvesting gains from the taxable bucket in her low income years, then filled the tax bracket with precise conversions that moved money from the tax deferred bucket to the tax-free one. Same accounts, same dollars, but now a very different lifetime tax bill. So in planning your income, your first question each year shouldn't be, what do I sell? It should be, how do I use the buckets this year to minimize my lifetime taxes? Imagine walking through a parking lot and you see money on the ground. Then you see another. You walk a little further and then there's more again. Do you stop each time, bend down, and pick it up? And how much does it take to make it worth the stop? A penny? A quarter? A dollar? The years after you stop working, but before you're forced to take income through RMDs, are very much like that parking lot. Every year, you have the opportunity to use the tax code for your benefit rather than what's best for the IRS. You're picking up that dollar. Unlike the parking lot, though, once you pass on picking up that dollar, you can't go back. How you draw income from your tax buckets is locked in each calendar year. Once that calendar turns, you've lost the opportunity to pick up last year's dollar. Tom and Jean are retired at 62. We use those lower income years to move money from the tax-deferred bucket to the tax-free one, up to the top of the most favorable bracket. We call this filling up the tax bracket, taking control today so there are no surprises tomorrow. When Tom and Gina are forced to take withdrawals later, it won't create a big tax problem, and they'll have a source of tax-free income. So the important point here is to be intentional about where your retirement income comes from. And here's how. Start with the taxable. If you're already getting taxable income from things like interest and bonds or CDs, dividends from stocks, or income from a pension or Social Security, use that for your core income. You can then realize some long-term gains and losses in your portfolio to generate more income for the year if you need it. Fill up the tax bracket. If you still need some more income, take it from your tax-deferred bucket up to the top of your tax bracket. If you don't need all that income, do a Roth conversion up to that amount. Then use the tax-free bucket as a pressure relief valve. If you've got some extraordinary expenses that you need to cover this year, draw tax-free money to avoid paying taxes into the next tax bracket if you don't want to. Now, just this little side note. People have heard me say, never touch tax-free money until later in retirement. And I still believe that, but it isn't a rule. It's just a tool. You should use the tax-free bucket if it makes sense in that tax year. Let's see how this works in a real-life scenario. Two different 63-year-olds, Alex and Jordan. Both have some pension income, but each needs another $90,000 from their portfolio to cover their comfortable lifestyles. Alex decides to raid his tax-deferred bucket in these early retirement years. His taxable income spikes. His Medicare premiums will be higher in a couple of years as well. He walks right past dollars on the ground without picking them up. Now, Jordan walks a different path, the intentional one. He draws from the taxable bucket first by harvesting gains and losses thoughtfully. This then gives him some room in the income tax brackets to fill the tax bracket each year with small, precise Roth conversions. Now, fast forward to 10 years later. Alex is still taking money out of his IRA, but is also paying capital gains in his taxable accounts. Jordan's IRA withdrawals are smoother and tax controlled because some of it is tax-free. Same portfolio, different lifetime tax bill. Want to see your Alex versus Jordan scenario? Schedule a call with us by clicking the link in the details of this video. So let's unlock the biggest tax save move you will ever make, because it explains everything. It's completely legal and the IRS hates it. Deliberately convert tax-deferred money into tax-free, paying tax now on purpose. I know that sounds backwards from what the financial media has been telling you for years, but a known controlled tax today can be much cheaper than an unknown and possibly quite higher tax tomorrow, especially if it prevents large forced withdrawals that drive you into higher tax brackets and make more of your other income taxable. Now, I'm not saying convert everything, but every year reevaluate how much income you need and where it is coming from, and convert precisely what makes the rest of your plan cheaper. Control is the operative word here. And don't do this by intuition, because this is counterintuitive. At Advanced Wealth Advice, we create a proactive retirement plan for you that minimizes your lifetime tax liability. We do this by first generating annual income from the most tax beneficial sources. Then we adjust your tax allocation in your portfolio every year. And then finally, we execute a tax-aware investment plan. All of this can, depending on your unique financial situation, dramatically reduce how much you end up paying to the IRS over the course of your retirement, sometimes by hundreds of thousands of dollars. Imagine next year being very different than years past. You'll know exactly how you're going to take your income from your portfolio. Your tax return is boring. There's no surprises. The ups and downs of the stock market don't rattle you because you know your withdrawals are diversified across tax buckets. Your future forced withdrawals, or RMDs, don't push you into higher tax brackets. And the pressure relief valve, the tax-free dollars that you can draw on whenever life hits you with a curveball without creating a new tax problem. You can make this a reality by scheduling a free initial consultation. Just click on one of the links in the details of this video to either watch another video that describes more about how we work with our clients, or find an open time slot right now. Thanks for visiting our Hot Take videos. I hope that you finish each one feeling a little smarter than when you started. Thanks for watching and have a great day.